Being a bank is just simply about control. Well, why not you be that bank where you have that control and you're making that money instead of them making all that interest off your money? Why aren't you making all that money off your money? And that's really, at the end of the day, all it's all about.
As you're using the cash value, that money that you put into that whole life policy is growing uninterrupted. Unlike a savings account, where if you took the money out of a savings account, you're going to interrupt it.
Hey, what's up, everyone? Welcome to Wealth Webinar Wednesday. My name's Stephen Nagy. I will be hosting the show today alongside my guest host, Mr. Craig Yenny, aka the Freak in the Sheets, because of his genius brain behind all of the BYOB vault tools that we use and his use of spreadsheets. So what's up, Craig?
Hey, Stephen. Thanks for the intro. And, I love to run the numbers because at the end of the day, we're trying to solve problems. Right? We want to use infinite banking, a concept process to solve problems. A lot of times what we do is we put the math to the test to make sure it is going to solve your problem. Whether you're trying to pay down debts, whether you're an investor, maybe you want to buy, a major purchase, a car, we want to put the math to the test and show how it's going to work for you. So that's what we're all about.
Absolutely, man. Absolutely. So we're going to dive into a couple slides here. Like I said, we're going to make this more interactive and fun. So if it's your first time learning about infinite banking, we'll definitely hit some of the basics. If you're 50th time learning about infinite banking, we're going to also get into some stuff maybe you've never heard before. We'll get into some new case studies, some new examples, and we're going to talk through this together. Maybe there's a dying question you've been wanting to get answered. Craig and I are here to dive into that, and we will make sure it all makes sense by the end here. We will also invite all of you, if you'd like to continue the conversation. We're going to be putting a link over in the chat box to connect with one of our money mentors. So Craig and I have personally trained a team of individuals. They are all Nelson Nash Institute certified infinite banking practitioners. And they are all personally trained by not only the Nelson Nash Institute, but also by the BYOB money multiplier system. And all of our mentors also have a lot of experience, not only with infinite banking, but with general financial consulting and investing. So they are able to talk through all kinds of different situations. And like Craig said, our number one goal here is to teach you how to take back control of your money and solve your money problem, whatever that is. So it's a great way to kind of ask that first question. What does becoming your own banker, what does becoming the bank mean to you? And I want to ask that question seriously. I would love to hear over in the chat box, what does becoming your own bank, when you hear that, BYOB, what does that mean to you? Just put it over in the chat box. I would love to hear it because I have some examples. I know what it means to me. I want to know what it means to you guys. And while you're putting those answers in there, I'll just dive into this a little bit. Okay. So what we do with infinite banking, becoming your own banker, it is all about control.
Mm-hmm.
And, when you look at the way money flows, the way that most people look at money, it's always going to be what we've been taught by our parents, what we were taught in traditional education, just kind of doing what's always been done before. And a great example of that is a 401k account. Craig, have you ever had a 401k account?
I did, and I gave up on it over 16 years ago when I started infinite banking. But yes, I used to do the 401k, I will admit.
Yeah, and why did you do it?
Well, I did it because everyone's told to do it. You get your first job and you sit down in your HR department and they tell you about all the benefits and get you signed up for the 401k and you want to max that sucker out and we aren't really taught anything else other than to do that. Get your job, put your money in your 401k, fund it for 30 to 40 years, and at the end of that, hopefully it works out for you.
Yeah, right. And very similarly, it's one of those things that, you go to your first job, maybe you're right out of college, you sit down and your first day there, they send you to the HR department and they tell you about all your employee benefits. Hey, we give you health insurance and you get all this paid time off and vacations each year. And, you're looking at all this and, oh, and by the way, we, offer this incredible retirement plan in the form of a 401k. And, you look at it like, okay, well, okay, I don't really know much about it, but is that what everybody does? It's a benefit that I get for working at this job. I look at all my coworkers, everybody else is doing the 401k. So you just kind of start doing it. And, at first it sounds good. The money comes out of your paycheck before you ever even see it. It goes right into this 401k. It sits there and it grows in the stock market over time, and it's tax deferred, and it all sounds great. But in reality, what is the 401k ultimately doing? Ultimately, it's forcing you to give up control of your money. Because what was the key word I said in that entire sentence right there? They take the money out of your paycheck before you ever even see it, and they put it right into that 401k. So before it comes to our bank account, before it comes to our pockets, anything like that, it goes right over to that 401k. And it does that because you avoid taxes on it. It's pre-tax money, so it reduces your taxable income. And the thought process in a 401k is, well, in my earning years, I pay less in taxes. In my earning years, I'm paying more in taxes, I should say, because I have a higher earned income. And so I want to get as many deductions and lower my taxes as much as possible. So I'm going to put that money in a 401k and then it's grow tax deferred. And then, I'll pay the taxes later because in retirement, I'll be in a lower tax bracket because I'll have less earned income and, I'll pay taxes at that point. But inherently, what are some challenges with that? Because number one, what do taxes tend to usually do in our lifetime? Do they go up or down? I can say I'm
Uh,
40,
uh,
42 years old, Craig, and I won't ask how old you are, but in our lifetime, taxes have never gone down. There's been tax cuts and breaks and stuff, and it kind of bounces up and down, but ultimately have always kind of gone up, and they always will. And it's just the way it is. And so, we're putting off paying taxes for later on, but if taxes are going up, and also, I mean, Craig, do you want to be barely getting by in retirement, or do you want to be able to retire nice and have a great lifestyle and all the rest of it?
yeah, I mean, it's about I want the cash flow to live the lifestyle I want to live. And as we're talking about these different things we're taught early on in our years, now I'd love to hear from the community, but when I kind of boil this down, we're taught to lock our money away in these retirement accounts, right? So first, lock your money away, give up control, let someone else take care of that. We're going to trust some stranger to care for our our money in this 401k or this investment vehicle. And what we're going to do is we're going to put it at a risk to get the highest returns we can because we want to go full blast when we're young and try to build this thing up. So to me, that's the initial things that we're told is put our money in the 401k, give it to someone else to manage, and you might have three or four funds you can pick from. But here's what I want to kind of transition to is what do we need to use money for throughout our lives? So why do we need money? What do we do with money throughout our lives? But
Yeah,
yeah,
and put that in the chat box. And you're absolutely right, Craig. And I bring up the entire 401k just as an example of, you know, the traditional way of looking at things. Like, why does everyone put money in a 401k? When you really break it down, it doesn't necessarily make all the sense for everybody to do that because of this right here. Like, why do you need that money throughout your lifetime? So let's see what somebody put on here. So money using as a means for exchange, but yeah, so pay bills, buy things, to strive and build. I'll give you a great example, Craig. When I wanted to purchase a home, if I wanted a down payment on my home, well, guess what? If I go to use that money from my 401k for that, what's going to happen? They're going to penalize me for taking the money out, and I'm going to pay taxes on it anyways. And I could give you a million different examples of this. So we're just giving up control of our money. But go ahead, Craig. I'll keep reading something. Start a business, rent, build a legacy, buy freedom. There's some answers that people had right there.
yeah, I mean it's create your business, buy cars, and so all of these answers that people are putting in there, I just want to draw the correlation of all of those things that we're talking about. Does it work that well if we have our money locked up for 30 or 40 years? Can we use it to start a business? Can we use it to pay for cars? Now, I know you can take loans and you can do different things with that loan, so you still have some access there, but at the end of the day, we always have to look at what are we told, what are we trying to use money for, and do those two things match? And if not, we need to find a different approach. And Stephen, I was just thinking about a call I had yesterday. A guy was talking about wanting to get to retirement, and he's like, "Well, what are some of the things I should be thinking about?" And I said, well, I think there's two camps out there. There's the accumulation camp, which is just squirrel your money away for 30 or 40 years. Hopefully you build up a big enough nest egg to then draw down, and hopefully you have enough money to make it to the end. There's another camp that says we should use our money through our life while we're building cash flow, while we're not so concerned about building a big nest egg. We're concerned about building cash flow. We're concerned about being our own banker and funding the major purchases and keeping that money in our own control. So those were the two kind of camps that I see, and you can kind of pick which one you want to be in. And at the end of the day, I'd rather have cash flow than a big pile of money.
Yeah, absolutely. And a lot of that right there, Craig, just comes to you understanding that if you can think differently, think outside of the traditional way of investing, the traditional way that money works, that you can put yourself on a much better path to be able to succeed and reach those goals, to generate that cash flow. You understand the basics of how money flows. And that's exactly what we're going to get into today, because something, Craig, I've been talking, thinking a lot about is just simply perspective. You see a lot of examples, a really good example of that. You see like kind of a meme going around a lot of times where you have an iceberg and you have, the little piece of ice that's sticking out of the water that, shows success, the little piece, I'm talking about the
Oh
iceberg,
yeah.
but then it
Yep.
goes under the water and that iceberg's massive under the water. Now, all people see is the little, piece on top that's sticking out. And that's, Craig, that's you, that's me, that's Chris, that's, our students and our clients that, grasp what we teach and they follow the plan that we create for them and they get themselves. And that's where they get popping out of the water. And, that's the person. And everybody else is looking around like, oh, look at them. They're doing awesome. It's so great. What they don't see is what's below that water line. All the education that they had to teach themselves to understand this. They had to actually take action on it. They had to get on a phone call, work with a coach, work with a mentor, work with somebody that was going to help them and guide them and show them a better way, and then get over the fear to be able to go out there and make it happen. And, that's simply perspective right there, changing your mindset a little bit, changing that perspective. Or have you ever seen the one where it's like the kitty cat is, looking at the reflection in the lake, and the reflection in the lake is really a big tiger. It's like,
Yeah.
how do you see yourself? Like, do you see yourself as this little kitten, or do you see yourself as that lion, that panther, that mean animal that's ready to go out there and make things happen? And so it's all about perspective. And so a lot of what we teach is, we talk about things like the backwards bicycle video on YouTube. And, if I could turn my camera around right now and show you my bookshelf, I mean, I have hundreds and hundreds of books on mindset, on investing, on positivity, on different things of that nature. Why? Because you got to constantly feed your mind this stuff, because what else is all around us? Negativity. Just watch the show this morning that I just did. What the F happened? It's just all garbage news and all garbage noise out there that doesn't truly affect our individual lives on a daily basis. But that's what most people surround themselves with. And social media in the last decade is just exemplified that. It's like just put it up on such a pedestal. So how do we take that back? And so I congratulate every single one of you that's on here right now for being on this webinar, for getting away for some of that negativity, the news, the social media, trying to do something better for yourself. So we're going to dive right into this. I don't want to waste too much time on mindset and whatnot, but I just wanted to say congratulations. You guys that are on right now are what we consider our 5%. Because Craig and I, we've studied this stuff. Chris and I, we've studied this stuff. If you take 100 people, you take 100,000 people, you take 1,000,000 people, it's always going to be about 5% of that group that actually embraces what they see, takes action on it, and does something with it. And you can do that almost across the board in any industry, any example, anything like that. It's always about the 5%. So I always consider you guys my 5%, those of you that are ready to rock and roll and be good. And so what we're going to focus on today are the left side of the screen. Again, mindset is going to be overcome easily. And I could talk for an hour and a half just on these topics right here, which we're not going to do, but we're going to focus today on taxes. How do we eliminate taxes? How do we reduce taxes? How do we be smarter with taxes? Inflation. How do we get that out of our lives? Volatility. like we always say, Craig, the crazier it is outside, out there, the safer it is, the more comfortable it is in here in our BYOB campfire. And then one of the wealth killer's interests, we're going to talk a lot about interest here in just a second when we look at how does banking work? Because I started with that question right there, right? What does being a bank mean to you? And being a bank is just simply about control. And when you study the Federal Reserve System, when you study the central banking system, when you learn how banks operate and what banks actually do, you can see everything that they do is based around them trying to get your money. Get your money. Why? So they can control it, so they can make billions of dollars off of it. Well, why not you be that bank where you have that control and you're making that money instead of them making all that interest off your money? Why aren't you making all that money off that interest off your money? And that's really at the end of the day all it's all about. And so yes, we're going to talk about money. We're going to talk about banking. We're going to talk about the infinite banking concept. But at the end of the day, it's about control. It's about power. And what is the most powerful thing in this world? It's money, it's information, it's knowledge, but it all leads to money. Like it or not, Craig, like it or not. Money's the root of all evil. Money doesn't buy happiness and all the rest of that. Admit it or not, money is important. It's powerful. And the more we can understand and start implementing some of these simple strategies, the better off we're going to be moving forward. Is that fair enough to say,
Well,
Craig? And I'm going to
it
move on.
is, and I'll say I was following somebody in a car ahead of me one time. They had a bumper sticker said, "Money is the root of all evil," and I thought, "Hey, let's pull over. I'll take all that evil from you, and I'll do something good with it." Because the real statement is the love of money is the root of all evil. Now, we're not talking about loving money so that we can buy more crap and we can, have this flashy lifestyle. We're trying to build it for our families, for legacy, for the freedom. And one of the things I just want to kind of mention is with that mindset that you had is, at the end of the day, if we just start looking at not what the banks and the big financial institutions are telling us to do, if we watch what they're doing and we do what they're doing, that's really the basis of what we're talking about. We want to do what they're doing. We want to loan money, make arbitrage on it. We want to be in control of that money. We want to make money off of money. They want us to put all of our money in their system so they can go make more money off our money. And it's just don't do what they tell us to do, do what they do. That would be the way I would describe it.
Yeah, absolutely. And it all starts with understanding that, having the open mind to be able to change your mindset and way you look at money and the way that it flows. And then just simply saying, listen, I'm going to follow something that's been done for well over 200 years, this exact same strategy. Been done by some of the wealthiest, most successful people in the world. I mean, just to give you a couple examples of who has used this strategy throughout history. It's used today by colleges, by professional teams to pay coaches. It's what's called a deferred compensation plan, but it's been really being utilized over the last 15, 20 years now in those industries. Politicians have been using this for many, 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 many years. People like Walt Disney used it to start Disneyland. Doris Christopher for Pampered Chef. Ray Kroc with McDonald's have all used this exact same strategy. So it's simply understanding, hey, listen, somebody else that's, maybe a little smarter than me, or maybe, had a little bit more experience than me is doing this. And let me listen to that person. That's exactly what this is all about. Some of the wealthiest families in the country, people like the JPs, the Morgans, the Chases, the Rockefellers, and that's what it's all about. So what we're going to do right now is we're going to start getting into what is this money multiplier method and how do you start learning and applying this right now today. And in the next 60 minutes, you're going to see exactly how this works. And we'll invite you to schedule that phone call with one of those money mentors that I mentioned before to talk about your specific situation. Because Craig and I are going to give you some examples. We'll give you some case studies of other people, but we want to build a strategy and a plan for you. And then not only that, but to Tess's point over here, I just saw in the comments, where did it say it? Tess said, then we can teach those in our lives. The more we learn and share, the more we dispel the money myth. We give people back control. And I absolutely love that, because one of our favorite things to do is to educate somebody that's never heard of this before, create a strategy, hold their hand to help them implement it, have them have success with it for a while. And then guess what we do at that point? We invite them back onto one of our podcaster shows and we do a case study with them. hey, let's show a real life example using you. So I will challenge everybody that's on right now, who is going to be our next case study to do a webinar or a podcast with Chris Naugle? Who wants to be the next one? Put it in the chat box. If you've already started a policy with us in the last couple years, 2, 3, 4, 5 years, and you love what we do, please let me know in the comments. We'd love to have you on the show. But hey, I'm having success. Here's what I'm doing. I would love to share it with other people. And what we'll do is we'll arrange with our video editor and our team to schedule this with you, and we'll have some fun with it. So please let us know if you're already doing this, or if you're brand new, say, hey, I would love to be able to do that. Now, do we require that? Absolutely not, by any means. We have thousands of clients, and there's no way we could do this with all of them anyways. But is it a lot of fun? Absolutely. Tess loves it. I know Shane, you just did one, right? Yeah, the case study is a great experience. Highly recommend. Yeah, Shane just did a really, really cool one with us. Amber's new, but she's wanting to do it. Very cool. Yep, Robert eventually wanted to be on a podcast with Chris. Absolutely. Elisa, I have a policy just getting started, but check back in 1 year. I love it. I love it. I love it. Frank is trying. Brent, I'm open to doing one. All right. Yeah, Brent, I know you've opened all kinds of policies at this point.
Yeah,
Like I
Brent would
said,
be awesome to have on just to because he's got company owned policies, and that's a whole nother twist to this where we're using the policies to help fund things in the business. So Brent has a great story for what he's doing.
yeah, and the last thing, Craig, before I dive into this, somebody just asked, what's the book called that dives into infinite banking? There's a few, and I'll pull this up just to give you a couple recommendations. This is a good one right here by Robert Kiyosaki. He talks all about the infinite banking concept, and this book's Second Chance. I'm a huge Kiyosaki fan. He was one of my mentors when I was just getting started in real estate and entrepreneurship. Tony Robbins, I've been reading his stuff for well over 20 years now. He's one of the first guys I ever read, kind of the self-help motivational stuff when I first learned about it. Yeah, it's been almost 20 years now, actually. But this is probably the one you're thinking about, is Becoming Your Own Banker by Nelson Nash. This is kind of like Nelson Nash was kind of like the godfather of modern day infinite banking. Again, this strategy has been implemented and used for over 200 years. Our Nelson Nash kind of brought it to the mainstream back in the 80s and 90s, and it kind of just took fire, from that point forward. And so we credit Nelson Nash with a lot of what we do, and what Craig has been able to do with using technology, building tools to prove out a lot of the concepts that Nelson Nash teaches in that book, Becoming Your Own Banker. It's really cool to see the theory of a book meet reality of the real world, the way that we do this with our tools that Craig has created. So just to give you a heads up on what that means, when you schedule a strategy call with one of our money mentors, it's a free call. It's a 45 to 60-minute Zoom meeting. So I would like you to please be on video with your money mentor, either on Zoom or Google Meet. We can do it either way. If you really need to be on just a phone call, that's fine as well. But I like the video because you at least start to get to know each other a little bit better. It's a little more personal than a phone call. And at the end of the day, your money mentor is going to have a huge impact in your life for years and years to come. So I would love for you to be able to now meet them virtually, and then eventually one day meet them in person at an event. I mean, I could tell you a bunch of people in the chat box right now that was their journey with myself. Now, so please schedule that call. But what we'll do on that call is bring what your problem is. Are you in debt? Are you trying to grow wealth? Are you legacy planning? Like, what is it you're looking to accomplish? If it's debt, for example, bring your debts with you, because that money mentor is going to immediately start learning all about you. What's your financial situation look like? What money problem are we trying to solve? And we're going to immediately start doing that. And we'll gather the data that we need at that point to build you the perfect infinite banking policy, which we'll talk about what that is in just a second, as well as the perfect strategy and plan. And we're going to do it using those tools that Craig created called the BYOB Vault tools. So that way we can take all this theory, all this talk that we're doing, and we could put pen to paper, as they call it, and put it into reality to show you exactly what it's going to do for you using modern day mathematics and technology. So that's what that's going to look like, but it's all based around that book right there, Becoming Your Own Banker. Of course, here's another good one Brent Kessler and Chris Naugle wrote a few years back called Mapping Out the Millionaire Mystery. All of you should have received a digital copy of that book for registering for today's event. If you did not, let me know and I'll send you a link to download. Just put in the chat box if you want want it. And I'll put in a second a link so you can download that book right there, as well as this one, the Private Money Glide Real Estate Edition. This starts talking a lot about real estate investing and private lending, which is one of the top ways that our clients and students use their policies to start moving money to do, like Craig said before, to keep that money moving and making more money for you at all times. Private lending has become a huge strategy for a lot of our clients, and the basics of that strategy are taught in that book right there, the Private Money Guide. So if you guys want a free copy of those books, let me know and I'll put the link in the chat box here in just a minute. But with that being said, Craig, let's go ahead and dive into a little bit about what this method looks like, okay? So we're going
All
to
right.
break this into three different sections for you today. So number one, we're going to talk about the machine itself, and then we're going to do some case studies, okay? So what does it look like to actually use this machine? What does it mean to do the infinite banking concept? Because is this a get-rich-quick scheme? No. Can you start getting full advantage of this machine from day one? Absolutely. But it's not a get-rich-quick scheme. It's going to take time. It's more of a marathon. It's more of a strategy that we need to constantly be looking at least once a year. So we need to think about it, okay? So not daily, but once a year. And then we're going to talk a little bit about what most everybody's favorite subject is when it comes to this, which is the millionaire. How do we really start creating that legacy and creating wealth for ourselves to do, like Craig said before, to create the cash flow to live the lifestyle that we want to live? Because this day and age, Craig, being a millionaire in 2025, and this is crazy to say because it's changed so much over my lifetime, but being a millionaire in 2025 doesn't really mean anything anymore. Isn't that wild to think about?
Yeah,
You
it
could be
is
a
wild.
millionaire this day and age and barely getting by. Like it's pretty fascinating. And so, like Craig mentioned, it's not about the money, it's about wealth and that lifestyle and what that looks like to you, the cash flow, being able to do what you want to do. Go ahead, Craig.
I was just going to say that $1 million. I had a conversation with a person that's in their late 60s in retirement. They have $1 million in their 401k, and they reached out to our team just for some ideas, and we've talked about some different strategies, but their financial advisors telling them they could take about 30 to 40,000 a year out of that $1 million 401k. He's like, I can't live on $30,000. And so I'm like, that $1 million nest egg is not really doing much for them, but there's other strategies you could do. But it's just to your point, I mean, $1 million doesn't go as far as it used to. That's for
Right.
sure.
Yeah, exactly. And so we'll dive into this now. So let's talk about the machine. What is this machine, Craig?
The machine is a specially designed and engineered dividend paying whole life policy from a mutually owned insurance company.
Absolutely. Now, a couple clarifications about that, if you don't mind, Craig. You want to expand a little bit?
What specifically do you mean as far as
You
what
know what?
the
You know why? Like, why do we use a mutually owned dividend paying whole life insurance company? Why whole life insurance? And,
yeah.
where would somebody maybe get one of these?
Yeah, so I mean the thing to think about is the infinite banking concept process is just that it's a process and it's a way of taking control of your money. Can you use a savings account? You could. Could you use a margin account in your stocks? You could. We have just found, and through this process, that using a whole life policy that is specially designed and engineered, it offers so many different benefits that nothing else compares. And if you find something, share it with us because we'd be happy to look at it. But what does a whole life policy offer us? Well, it gives us that uninterrupted compounding. There was a question earlier in the chat of, hey, I didn't know I could actually take a loan from this, or I could use the cash value. Absolutely. So think of it this way. As you're using the cash value to purchase a car and repay your own system, that money that you put into that whole life policy is growing uninterrupted. Unlike a savings account, where if you took the money out of a savings account, you're going to interrupt it. There's a death benefit that comes along. And if you want that death benefit to protect the income in your family, create legacy, that comes along for the ride as well. It grows tax free inside of the policy, right? So that there's just a number of benefits that when we look at all the other tools that we could choose from, this is frankly the best one to use.
Absolutely. Absolutely. And, one of the things I wanted to clarify real fast as well is Craig, myself, our money mentors, we are licensed life insurance agents. And we're licensed life insurance agents so we can properly design these policies for you to be the best that they can be to solve your money problem when it comes to infinite banking. And so we partner with these large mutually owned insurance companies with multiple ones of them. Why? Because that way, Craig, if we're looking at someone's situation, their health, their age, the amount that they want to fund the policy with, the premium, all these different things go into account why we're doing this for the client. And then we can look at it and we can say, okay, do we want to use One America? Do we want to use Lafayette? Do we want to use Penn? Do we want to use Guardian? Do we want to use Mass Mutual? Do we want to use Securities Mutual Life? Which one of these large mutually owned insurance companies will fit this client the best way? And so it really opens up our options to be sure that we can help the client in the absolute best way possible. And the other advantage for us being able to do this way is because we're licensed agents, this is how we get paid. A typical life insurance agent, they're going to sit down with a client and they're going to talk to you about what the right amount of death benefit is for you. Now, how many of you have a it might be easier to ask, how many of you do not have a life insurance policy? If you do not have a life insurance policy, put that in the chat box.
Yeah, and while we're waiting for that, I mean, Scott put in there there's a lot of things on the list, but Scott mentioned in a mutual company, those dividends that are being generated are shared with the policyholders. And you contrast that with a stock company who answers to the stockholders. So why we use a mutual company is because we want to be part of the growth of that insurance company. Whereas a stock company, it's no different than any public company out there. They're answering to their stockholders. So just a lot of really cool benefits. In some states, you have protections against creditors and predators on the cash value. If you live in Colorado, Shane, I know you and I are out here in Colorado. We don't have the protections like a Texas or a Florida would, but there's still some level of protection of our cash value.
Yeah. And like Chris said, with a mutual company as a policyholder, you get to share in all the dividends, not just some. And so lots
Yeah.
of advantages. But again, this is all stuff we do as a company. We study this stuff. We find the best of the best and we bring it to you. Now, when you sit down with a regular, so those of you that don't have life insurance at all, the older I get, the more, my son grows and I talk with clients and I meet people, the more important I understand just life insurance in general, how important it is. So those of you that have none, I would highly recommend it. And, life insurance agents have such valuable jobs. Like they sit down with you, they talk to you about how much life insurance is right and to get you the right type of life insurance and everything else. And then the way they get paid is they get paid a commission for selling you that life insurance policy, just like any other insurance agent, health insurance, car insurance, anything out there. It's all the same, right? And they deserve that commission because they spend time, they figure out what's best for you, and they help you solve a problem getting life insurance for you and your family. So I absolutely love that. Now, what we do is just a little bit different. We, instead of talking to you about how much death benefit is right, yes, these policies have death benefit. It's the cherry on top, but we're going to talk to you about using this policy in a different way for infinite banking. But guess what? We get compensated the exact same way. We get compensated through selling these policies from our partner companies that we use, these insurance carriers. So they pay us directly. But here's the whole thing. Whether you go to some other insurance agent, whether you go directly to the insurance company, let's just say One America, for example, you can go directly to them or you come directly to us. They're going to get you the same policy. You're not saving money by skipping the agent or something like that. It's all built into these policies. And so the advantage of working with us is we have all these options. We're going to fine tune and tailor it exactly for you. We're going to build it in a way where we actually take a reduced commission. We actually make like 50 to 80% less than what a typical agent does. Don't worry, we do lots of policies, but this is all part of the reason why we operate the way we do. So I'm just kind of doing a little behind the scenes how we work here as a company. Does that make sense, Craig?
It does, and I'm just busy answering questions in the Q&A, so I love that you guys are asking questions. So make sure if you do have questions, put them in the Q&A. That way, as Steven's kind of running through material, I can try to answer those and vice versa.
Yeah. The chat box gets going sometimes when I ask questions and we share stuff. So make sure you put those questions in the Q&A section and we'll hit all those. All right. So what else does this machine do? Well, if we want to talk about mimicking the banks, which is what we just all agreed that we should probably start doing, we need to start thinking how banks think and start operating like banks operate. So if we start studying banks and looking what banks do, did you know, Craig, that over 90% of the M1 money supply of banks goes into two different asset classes? Do you know what those are by chance?
Well, I know what one of them is, and let's see if our community knows what those two are. So let's put that, yep, we got life insurance, and what's the other one?
Because you're absolutely right. So I'll hit that one. Bank-owned life
Mhm.
insurance. It's called BOLI, otherwise known as BOLI. If you've ever walked in a bank and you wonder why there's so many quote unquote vice presidents and executives in that bank, it's because by that person being an executive, a vice president, it gives the bank an insurable interest on that individual, and the bank can now purchase a whole life policy on behalf of that individual. It's called known as bank-owned life insurance. Banks are the number one purchasers of whole life insurance in the country, and they put a lot of money through these whole life insurance policies. Number two, there you go, you got it, Jeanette, right there, real estate. They put a lot of money into real estate in the form of buying physical property, very expensive property, skyscrapers, and some of the biggest cities, always have bank names at the top, branch offices all across suburban and urban and rural places all across the country. These banks buy real estate. And then what do they also do with their money? They take the money, and Craig mentioned it earlier, they lend it out. They make what's called a spread. And we're going to talk more about that in just a second. But they put the money into real estate deals. They do it using mortgages, using trusts, but essentially they're putting it into real estate. So this is what they're doing with that M1 money supply. So if banks are doing real estate and buying life insurance, would it make sense that if we want to be the bank, we might start learning how to do the same thing? And that's exactly what this is all about right now. So let's talk about it. How does this machine operate? What are some of those principles of commercial banking that we want to start mimicking, Craig? And I want to give a couple examples. So this is one of how spreads work. So when you have money, you go down to your bank, you deposit it in your bank account, or you take a picture of your check and it direct deposits into your account. We all know that the bank doesn't actually take your money and like just have it sitting there in a box waiting for you to come get it, right? What do banks do? Banks take that money, they immediately start moving that money. Again, money in motion does what? Money in motion is always making more money. All right, so I'll show you a couple of examples of how banks do this. So banks take money. Let's say you have $100,000, you put it in your account. Let's just use it. We'll use just numbers for fun here, but let's say that bank is going to pay you 4% interest on the money that you leave sitting at that bank. All right. So you put your $100,000 in that bank, you're earning 4%. Well, what does the bank do? They get that money moving. So they take that money and they lend it to somebody else to buy a home. And they're going to charge, let's say, that homeowner 7% on that mortgage. Then what happens? Well, whoever you bought that home from, what are they going to do? They're going to take that money, they're going to deposit right into the bank as well. That's what everybody does. And then let's say, okay, well, now somebody wants to buy a car. So they go down to the bank, they say, hi, I'd like to buy a BMW. The bank gives them an auto loan. Let's say they charge them 8% for that auto loan. They go to the car dealership, they buy the car. What does the car dealer do? They put the money right back into the bank. Maybe you want to remodel the house now. You go get a home remodel loan. That money goes to the contractor. Contractor puts it right back into the bank. Maybe you get in some debt. Same thing. Do a debt consolidation loan. Credit card companies right back into the bank. So at the end of the day, what just happened? Well, on this loan on the mortgage, the bank just made a 3% spread on your money. So if they're paying you 4, they're earning 7. They just made a plus 3% spread on your money. Okay. Same goes with the car. They made 4% on that note. Okay. Same on this one. 5% on the home remodel loan. They made, let's say, 6% or 8% on the debt consolidation loan. So at the end of the day, they just made 20% while paying you 4%. But what kind of money are they actually making off of your money sitting at that bank? Well, if we do the math here, you're making 4%, they're earning 20% on that same money. That's a 5x return. That's a 500% return that the bank is making on your money that you're depositing at that bank. Now we open this thing up with, if you're going to mimic the banks, what do we want to start doing? Moving our money. So what we want to start doing, learning. how to start moving our money in that way. And we'll talk about that when we start getting to the millionaire. But right now, I just want you to understand the principles of how banking works. This is how banks make money. They get your money, they do all this stuff to get your money, give you free checking accounts, give you all these incentive programs, run all these teaser rates for CDs and savings accounts, give you free lollipops when you go in there to the bank. They do all this stuff just so they can take your money and they can make a bunch of money off of you. And this isn't just Craig and I telling you this. You can go to this website just like we did. So we study this stuff, BauerFinancial.com. BauerFinancial.com is an independent organization that essentially rates and studies banks. And they tell us that banks make between 400 and 1,300% off money that you're leaving there.
Yeah, and Stephen, I think this might be a good spot just to ask the community, if you have a mortgage from the bank at 3%, brand new mortgage at 3%, or let's call it brand new mortgage at 7%, are you really paying 7% interest to that banker? Who thinks you're paying 7%? Who thinks you're paying a lot more than 7%? And Joe on our team, he's coined this as the devil's arithmetic, and I love it. But think of when you get a mortgage, and let's say it's a 7% mortgage, and just to make the number safe or easy, it's $1,000 a month is your mortgage. In the first 7 years, you're paying most of that money is going to interest. So you could be paying up to 70% of every payment's going to interest. This is the funny math that the banks are doing, and this is what we're trying to educate people on is you may not be able to get out of it today. Be aware of it and make a plan to get out of it because this is what's going on. They're robbing us blind. And every 7 years, what do most people do with their mortgages? They either refinance or they sell their house. And like Rena says, not unless you have an all-in-one. And we love the all-in-one. I have an all-in-one. The first lien mortgages, those are the way to go. So I can't agree with you more, Rena, on that one. But anyway, just kind of want to take a sidetrack and just talk about, because a lot of people look at these numbers and say 400 to 1,300%. How are they doing that? That's how they're doing it with the devil's arithmetic. Anyway, just want to make a quick stop there.
No, it's very important. Again, we're mimicking what these banks do. So let's do like the banks do.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
And then when it comes to, moving money and money flowing, there is a concept that all of us need to understand. And I do want to hit this real fast, Craig. It's the difference in what types of interest and what types of loans exist. And this is a very simple example, but it's something that I think everyone can relate to. So pay close attention here. All right. So let me ask you this question. If you know the answer, don't answer. But if you're new here, let me know what you think. Can you make money earning 4% while paying 6%? What do you guys think? And I'll show you exactly what I'm talking about. So the reason I said we can all relate to how this works is because we can all relate to buying cars and we can all relate to saving money in a savings account, traditionally speaking, at a bank, right? Everybody's bought a car in their life on here and everybody's saved money at some point in a savings account at a traditional bank, right? Okay. So let's say that you've been saving your money for the last several years to buy a car that's worth $25,000. So you have built up $25,000 in your savings account at your bank. You're stoked. You're excited. You say, hey, I'm finally gonna buy that $25,000 car I always wanted. I've been saving up for years. So you stroll on down to the bank, you walk in the door, you go up to the counter and you say, hi, I'd like to withdraw $25,000. Now, Craig, just on a side note, is there a problem there just to start with? Have you ever tried withdrawing $25,000 at once from your local bank?
Well, I have, and the question's always like, what are you doing with it and what's going on here? So
yeah, they're going to ask you a million questions. You're going to fill out a bunch of paperwork to make sure it's not being money laundered, it's not being used for illegal stuff. They're going to ask you all these questions. It's a real pain in the ass.
And I'm a smart ass, so I usually say stuff like, well, I'm buying a rare African zebra, and then there's more questions after that. So,
Yeah, so you can do what you want, but anyways, that's the nature of the beast. That's what's going to happen. So that's the first challenge right there. But nonetheless, let's just pretend that doesn't exist. You go in there, you ask for $25,000. That teller is going to look at you like this. Oh, you got a third eye, like, oh wow, 25,000. And then they're going to call over their guy in the suit, right? The VP I mentioned before, the executive, and they come over and they say, "Hi, okay, I'd like to, I understand you want to earn $25,000. Can you tell me this and that?" And then, okay, you say, "Okay, well, I'm going to buy a car with it." All right, and then he looks at you, goes, "Okay, well, listen, it's your lucky day today because I'm going to make you an offer. Do something a little bit differently. I know you've been saving your money, for the last several years. You have $25,000 in there. If you take that money out today, what's going to happen? Well, that money's going to be gone from your account. You're going to go buy the car, but the money's gone forever, right? So the banker's going to look at you and the banker's going to say, okay, well, I'm going to make you an offer. What if I allow you to keep your money? Keep your money in that savings account at the bank. And what we're going to do is we're going to allow you, instead of withdrawing that money, we're going to allow you to use that $25,000 in your savings account as collateral. And with that collateral, we're going to give you a loan to go purchase that automobile." And you say, "Okay, well, my money is going to stay in my savings account. And what is it earning in my savings account?" And the banker looks at you and goes, "It's earning 4% inside your savings account." Say, "Okay, is it guaranteed to earn 4% over the next 5 years?" In reality, no. But for this example, the banker looks at you and goes, "Yes, we have a promo special right now. We're going to pay you 4% in the savings account annually for the next 5 years." And you say, "Okay. And I'm going to be able to get your loan and go buy the car that I've been wanting anyway. So now I have my money and I can have my car. I get best of both worlds." And you look at that banker and you say, "Awesome. Well, what's the catch?" And he goes, "There is no catch." And you say, "Well, you're going to give me a loan for my car. I've never had a loan before that I don't get charged interest on. Well, what is the interest I'm going to pay on this auto loan you're giving me for $25,000? And they look at you and they go, "It's 6%. And you look at that bank, you said, "I knew it. I knew that you guys were going to try and pull a quick one on me. You just told me I'm going to have 4% in my savings account, and I'm going to now have to pay you 6% on this auto loan. I'm not going to lose money. Give me my money. I want to be." And the banker says, "No, no, no, no. Hold on. Let me show you how this actually works, how money actually works." So let me show you. We've already done the math here in this example. So let's say the $25,000, that's 6%. It's a 5-year auto loan. Okay, that's pretty common, 5 years for an auto loan. So $25,000. Now, what happens with an auto loan once you get that thing? You start making what? Monthly payments. So in this case, $483 a month is getting paid back to the bank. Now, what happens with your principal balance each time you make a monthly payment on this loan? That principal balance that started at $25,000 does what? It gets lower each month. So each month and each year throughout this loan, it's going to be a lower balance. And in this car loan, you're being charged that 6% interest on the balance that year. So over time, the balance is going to be less and less. So what happens here, the future value of this $25,000 is going to be right at $29,000 after 5 years. But what happens in the savings account? See, this is what we call simple interest over here on the left side. But on the right side, over in your savings account, what is going on? Well, over there, we have what's called compounding interest. And this is a primary principle of how the infinite banking system works. So watch this. See, over here in your account, $25,000 growing at just 4% for the next 5 years. What happens annually with that $25,000 balance? Does it go up or does it go down? It goes up each year, right? It's growing by 4%. So each year, that 4% is going to be on a higher and higher balance. So at the end of the 5 years, the same exact 5 years, that same 25,000 is going to grow to be just over $30,500. So by listening to the banker and doing what banks do, we actually would have just made $1,500 earning 4% while paying 6%. And again, I show this example because this is the basics of how the infinite banking concept works. We take our money, we put it into this whole life insurance policy that's specially designed with a mutually owned insurance company. As soon as the money's in there, we can now use that policy as collateral to take the money immediately right back out of there. That's the magic of all of this. That money goes into the policy. We can immediately, within 30 days, take almost all of it right back out of there to use it for other things. But what happens with the money that's in there? Well, just like in that example right there, that money's going to sit in there and compound and grow uninterrupted at all times. Why? Because when you take the money out to use it for other things, you're not taking your money out. You're using that policy as collateral, and you're actually borrowing against the insurance company's general fund. So you're using the insurance company's money, not your money, and that's what's allowing your money in there to compound and grow. Okay, and that's exactly what this concept is all about. So I wanted to point that out right there. Anything to add on that part real fast, Craig? And you could talk
No, I
about
mean,
this slide as well.
we could take a quick side road. I've got a slide on the whole premise of would you rather have $1 million today versus a penny that doubles every day? Have
Yeah,
you all heard of that whole exercise?
pull it
Yep.
up, man. It's a great example of the power of compounding interest.
Yeah, so let me just share that out because it's really a fun exercise.
And while you're pulling that up, and this is widely recognized and believed to be true, but you know who coined the phrase about the power of compounding interest was actually Albert Einstein. Albert Einstein is credited with calling compound interest the eighth wonder of the world. And Craig's going to show you exactly why that is right now. It's really
Yeah, and this example, I mean, it's kind of accentuated because we're saying, hey, do you want $1 million now or a penny that doubles for every day? But really, the purpose of this exercise is we want to see that power of compounding. And just like Marius mentioned earlier, he bought a car with his first policy, and he's got many, many years ahead of him. And time and compounding are two great forces that we want to use to our advantage. So anyway, before we go on, who wants the $1 million right now, or who wants the penny? So just put $1 million or a penny. A penny that doubles every day for 30 days. Which one do you want?
or $1 million that doubles every day.
Nope, $1 million now, or you get a penny
Ah,
that doubles every day for 30 days.
see, I'm used to infinite banking where I can have the cake and eat it too.
Well,
And just
not
connect it
today,
all.
not today.
All right,
We
fair
have a
enough.
lot of really sharp people here because they're all taking the penny. So let's just kind of see how the math works out because this is the power of uninterrupted compounding interest. So day one, wow, we've got a penny, and then by day 16, we've got 327. So you kind of look down the path here for the days. In 15 days, we have $163. In 20 days, we have $5,242. But as you can see, when we get to the tail end of this, 671 turns into 1.3 million, which turns into 2.6 million, which turns into
Just 13 days, we would have already beat the 1 million.
well, 13 days is $40.
Okay. Oh,
Yeah.
I see.
So this kind of goes, two columns here.
Oh, 28 days. 28 days is when we go over. I see it now. Okay.
Yep. Yep. 28 days is when we beat it. And I love this quote, and I think it was from Benjamin Franklin, but he says, money makes money, and the money that money makes more money. That's what we're talking about. So think about your policies and why we want to use a mutual insurance company, specially designed policy that pays dividends, because we get this behavior of uninterrupted compounding. Now, there's one more thing I want to show you. After 30 days, we have 5.3 million. What would happen if we simply took a $100 withdrawal on day 15 and one on day 25? We just took $200 out of the system. We lost $3.2 million of compounding. Doesn't that blow you away that if we just take $100 out at day 15 and $100 at day 25, that's what's happening when we use bank accounts or we use accounts where when we withdraw that money, the compounding stops. So anyway, I just want to share that because it always amazes me when I go back and look at this stuff. I call them the wealth erasers because we have withdraw from your account is erasing wealth. Taxes are erasing wealth. Fees that you pay are erasing wealth. And so what we're talking about inside of the policy, and I had a question earlier, what if I take my cash value out of my policy that's compounding uninterrupted and I go buy crypto? Hey, great, you can do that. Your policy is going to continue to grow uninterrupted. You can use that cash value for whatever you want. There's going to be no questions. They're not going to ask you, why are you withdrawing? It's just going to ask, how much do you want? Then you can go put it into crypto if that's your thing. It's not my thing, but if that's your thing, you can go put it in there. There will be growth and taxes there, but there's no growth and there's no taxes inside of the policy. So anyway, let me know if there's questions on this, but just be aware of those wealthy racers out there.
Yeah,
All right, Stephen, back to you.
it really is fascinating though, right? Like how you make it like one thing. And when you look at that in life though, like let's look at that over 30 years.
Yeah.
What are the odds over life of 30 years that something's gonna happen? Whether it's in your control or not. Maybe it's a medical issue. Maybe it's an unexpected death in the family. Maybe it's an accident, an automobile accident. Whatever the case might be, you trip and fall. It creates all kinds of medical bills you were not expecting. Something like COVID comes along and shuts down the economy. There's a recession that occurs. The stock market crashes. Like there's so many things in life that can go wrong. And so if you have this perfect financial plan, but if if we're looking at a penny doubling every day, just as an example, but if one little thing goes wrong over that time span, that entire plan gets completely thrown off. And you see that over 30 days in Craig's example, or 30 years in real life, just three little issues over that time span. I mean, that was like 100 and it was like 200% less, right? I mean, if there is five
Yeah.
point some million and they lost 3 point some million, I mean, that's a huge difference. So all of a sudden you're planning on being able to live this lifestyle in retirement, this cash flow. One little thing happens and it destroys your entire lifelong plan. And I see it, when I used to be a financial advisor, I was a licensed advisor. So I would meet with clients and I would see this happen in real life all the time. And it was heartbreaking, man. It's really, really hard to see. And it's one of the things that drove me away from being a financial advisor because I just didn't feel like traditional ways of money, traditional investing work for enough people. And it's what drew me to entrepreneurship. And it's what drew me to real estate investing because I had that control and I could start learning about concepts that the real wealthy people, utilize things like this, the infinite banking concept, and take advantage of things like the tax code book and take advantage of having companies and taking advantage of all the rules that we have in this country, all the laws that we have in this country that provide for us to do this stuff. And it's a really, really cool thing. So I love that example right there, Craig. Thank you for sharing that. And we're actually at a point right now in 2025 of where things are going wrong right now for a lot of people. What have we seen savings accounts do over the last couple of years, Craig?
Well, I mean, as far as the amount of income going into them, it's dropped significantly from the COVID days. And of course, rates went up for a while. Now they're on the downtrend, but it's crazy to see that people just aren't saving money anymore. I mean, we're down below the 5% mark,
Yeah,
right?
so we study this stuff a lot. I mean, you look at savings historically in this country, people historically try and save about 10% of their income, which is probably not enough in the first place. But right now, that savings rate is dropped through the floor. In fact, it's gone into the negative where people are no longer saving. And guess what's happening? Credit card debt is skyrocketing right now. We just went this last year over $1 trillion nationwide in personal credit card debt for the first time ever, over $1 trillion. And that amount is continuing to climb. Credit card delinquencies, late payments and delinquencies are starting to really ramp up right now. We're seeing auto loan delinquencies really starting to ramp up right now. We see home foreclosure rates really starting to ramp up right now. So people are struggling financially, and we understand that. So how can we kind of still get by, make things happen for ourselves, still stay for the future, but still live the life that we want to live? And that's exactly one of the reasons why we do what we do. Because when we look at doing the infinite banking concept, and this might be the most important thing I say all day, so listen closely here. When it comes to the infinite banking concept and becoming your own bank, there's really one strategy you need to focus on to get started. Just one thing, and that's where your money goes first. So write that down. Where does my money go first? So I'll give you an example of how this works, Craig, and then we're going to get into some of your case studies, okay? So this is how most people earn money, okay? Let's just say for every dollar you earn, what happens with that dollar? Well, on average, about 20 cents of that dollar is going to go to an automobile, whether that's an automobile payment, gas, upkeep, maintenance, insurance, whatever. About 30 cents of every dollar you earn, generally speaking, it goes towards housing. And a large portion of that actually goes towards interest. About 25 cents of that 30 cents goes towards interest. And do we ever get out of paying mortgage interest? No, Craig mentioned it before. On average, people either sell their homes or refinance and get a new mortgage every 7 years. Well, if you look at an 30-year amortization schedule on a mortgage, about 70, 80, up to 90% of that interest is paid what? In the first 7 years.
Yeah.
Okay, so where else does that money go? Well, about 40 cents of every dollar goes to everything else, which leaves most people at the end of the day, 10 cents of that dollar, about 10%, goes into their savings. And like I just said, that is through the floor right now. Why? Because the cost of everything else is skyrocketed. I actually just saw a statistic this morning that came out. I think it was from the US Bureau of Labor Statistics, Craig. Listen to this. A $100,000 salary at the beginning of 2020, January of 2020, has the same buying power as a salary of $124,353 in April of 2025. So a little over 5 years later, a $100,000 salary to get the exact same thing, you now need to earn over $124,000. That's a 24% inflation rate just over the last little over 5 years. And so what does that mean? Well, all this stuff that we buy in our lives is now costing a lot more money, which are we all making that much more money? Most people are not. So what is going on with the savings? That has dropped through the floor. So what we do with infinite banking is we change this mindset. We change one thing where our money goes first. So instead of earning that money, paying everybody else, and then saving what's left over, we're going to save first. And the way that we do that is we change one thing, where our money goes first. So instead of somebody else's bank, Wells Fargo, Chase Bank, Bank of America, Seacoast, whatever the case might be, we're going to change that and we're going to put it into our own banking system first. By doing that, it allows us to save first. And then what can we do? Well, at that point, now we can start using our banking system, the money that we've saved in our financial lives to make all these purchases. So let's look at what that looks like using a car. Well, on average, 5 cents of that 20 cents that goes towards an automobile, on average, 5 cents of it goes towards interest on an auto payment. All right. So instead of giving that 5 cents of interest on that car to someone else's bank, what if we paid ourselves back? Craig, this is what we call being an honest banker. This is what we call being the bank. We're using our banking system to go out and buy that car. And then what are we going to do? Just like we pay back somebody else's bank, we're going to pay back our banking system with interest. But instead of that interest going to them, where's it going now? It's going to us. So right there in that one example of making that one change, we just increased our annual savings by 50%. Because think about it. If we were saving 10 cents before, we're still saving that same 10 cents of that same dollar, but instead of draining 5 cents to somebody else's bank, that 5 cents is coming back to our bank into our savings. That's an increase of 50% right there by making that one change. And what if we did that with everything else in our lives? What if we did that with housing? Like I said, 25 of that 30 cents goes to interest. Stop bleeding the interest. Credit card interest, everything else interest. Stop bleeding that interest. Let's keep that in our family's financial lives, in our banking system. And that's exactly what the infinite banking concept is all about. Changing one thing, where your money goes first, and be able to create this for yourselves. Does that make sense, Craig?
It does. And the one thing that's always jumped out to me about this slide, if you go back to the one where it's kind of got the 5% cut off or the 10% for the savings. Go back a couple. Yeah, just show the dollar with its splits. So and you mentioned this, but I think it's worth saying again in maybe a different way, but we're so focused at that little sliver of savings, right? That's where because of everything more expensive, it's harder to live, but that little bit that is being saved, that under 5% that we see in America right now, people are then taking some of that savings and going, well, I really need to probably put that at some high risk because I need it to grow. I can't just let it sit around. So everything's focused on that little sliver. And what we're saying is don't focus on that sliver. Go to the left of that line with the automobiles, the housing, everything else, and think about where that money's going. How can we plug some of those leaks? How can we run some of that money into our own banking system? How can we be more efficient with buying cars through our own banking system and putting down payments for a house in our own banking system? So all we're saying here, folks, is let's start shifting some of our focus over to where the money is being spent and going, and let's just figure out how to maybe capture some of that. So that's kind of what always jumps out to me when I see this, the dollar being broken down this way.
Absolutely. Now, did you want to pull up a couple examples of just, maybe paying off debt using this or something of that nature? We can give a couple examples of using the machine.
We could. I've got, if for those that have been following us for a long time, we show debt pay downs, we show investing. So, I mean, we can run through some of that briefly if you want to see that. And, maybe I just show a quick debt one. Let me pull that up.
Yeah, that might be cool. I mean, I have the
Sure.
same chiropractor example we've always used, but I know you have some kind of newer ones. And while Craig's pulling that up, I'll just, mention, I talked about the BYOB vault tools that Craig has created. Just to give you an example of what that looks like, we want you to bring those debts to the table, and that might be the wrong one actually.
Yeah, that's the major
Sorry.
purchase one.
There we go. So you want to bring those debts to the table because again, on that call, we're going to start collecting, okay, what credit card debt? And when you bring it to us, let us know who it is. So what kind of debt it is. Is it a credit card? What is the credit card company? Is it medical? Is it a personal loan? Is it auto payments, student loan payments? What is the balance? So what's the total balance on that thing? What is the interest rate you're paying? What is the minimum payment and how much actual payment are you putting towards it? We're going to want to know all that information because we're going to start taking that and we're going to start inputting it into our system. And Craig, I'll let you talk a little bit more about it, but
Yeah,
how
go
do we
back
start
one slide
analyzing
because
this?
there's a point I want to make that's important. So when we're asking for this information, if for example you look at the Amex credit card, it has a $3,500 balance, 27%. The minimum payment is 113, but you're paying 400. We get a lot of people coming to us and say, I just don't have the cash flow to do the infinite banking piece. And when I see things like this where we're spending another 200, 300 on a debt, and then we have another one we're spending 200 or 300 on a debt, and we have another one because you're trying to aggressively pay those down. Not that that's a horrible way to do it, but is there another way? Could we take that excess, run it through a policy, then take it from the policy and throw it at the debt? So we're getting that compounding machine started. There's going to be a little bit of drag. There's going to be a little bit of time and we have to build that policy up. But the question we have before us is, are we going to be a short-term thinker or a long-term thinker? Do we want to build wealth or we want to keep giving our money away? So why we're asking for those numbers is if you come to us and say, well, I don't have any money for a policy, and I see things like this, you do potentially have money to run through a policy, and we'll show you what that looks like. So I just wanted to express why it's important to list it out the way we're asking for it.
Yeah, absolutely. And again, we don't waste any time. We want to start really, we'll go at your pace. We have a lot of clients that come to us and they'll have 4, 5, 6 conversations before they're ready to, pull the trigger and get this thing going. We have clients that'll get on a call today. We'll chat with them. They'll hop on some webinars over the next year and a half, and something in their life or something will click. And year or 2 years from now, they get back on the phone with us, say, "Hey, now I'm ready to go." I get emails and text messages every single week from clients I spoke to well over a year ago that just the timing wasn't right, whatever the scenario, maybe they just didn't make sense to them at the time. But they say, hey, listen, this changed or that changed or my mindset changed. It's usually a mindset thing, typically, but hey, this all clicks now and I'm ready to get going. So, no harm, no foul. We encourage you to explore this, schedule a call with our money mentors, and absolutely zero pressure whatsoever. I can promise you that, but by all means. But yeah, we're going to start getting into it right away. We don't want to waste time because we also know that a lot of you don't have time to waste. We know you need, like, every single day could make a difference in your success or not. So if you know you need to get this started, like, tell us that on the call. We'll make sure we expedite, we move things along quickly for you. Like, we'll go at your pace though, is the bottom line, but bring us what we need to make you successful so we can start analyzing this stuff. Craig, do you do the lowest to highest balance, the highest to lowest, the highest to lowest interest rate? Do you do this or do you use IVC? There's been scenarios also where we've looked at somebody's debt, and because it's a unique type of debt or situation financially that they have, infinite banking is not right for them right now. Like we do tell clients pretty regularly, like, hey, you're not ready for this yet. You need to do this, this, and this first, and then you'll be ready to do infinite banking. Trust me, we're not going to start a policy with you just to start it. We actually get penalized if you start a policy and then you, for some reason, can't keep it going. years to come. So it's one of those things where we want to work with the right clients and the right people, and we want you to feel the same about us. And that's the reason we do a lot of what we do. But this is what that, kind of what that debt blaster is going to look like that we'll give you to show you exactly what your personal plan is.
Yeah, and is there any way you can kind of blow this up? Because I want to focus in on option 1, 2, and 3, and this might be enough just to kind of share with the community for today. Is there any way to make that larger? If not, that's okay.
Don't know.
Okay. When we talk about debts, do you want me to share out?
I was gonna see if I could just pop this thing. Or I can zoom in. Here, let me do it this way.
Okay.
It's gonna be a little mucky looking, but
Oh, that's perfect. I just want to make sure everyone can kind of see. So there's different reports, so if you are trying to pay down debts, there's a certain tool we use for that. Or if you're an investor or you're trying to perhaps buy a car and you want to see how this works, we've got all those tools built out. But when we're talking about debt, we really break that down into kind of 3 different options for you. Of course, there's many other things you could do, but what we want to say is option 1, kind of think of that as you really don't have a strategy. You're just going to pay down all those debts one by one. And let's say you've got a Chase card. What is the first debt at the bottom of the list, Stephen? If you scroll, I think I don't know if we have that on that slide. Go the other way to the bottom. Oh, we don't have it in there. Okay. So let's just say you've got a Chase card and that's the first debt you're paying off, and you are paying $200 a month to that debt. What do most people do with that $200 when that Chase card's paid off? Stephen, what do you think most people do with that $200? Deborah says use it.
Probably go spend it.
Blow it. That's kind of what happens is people will pay that debt off and it just gets absorbed into your operational monthly cash flow. Maybe you go out to eat more, you spend it, right? So we always show you worst case. If you continue to operate that way, this is how long it's going to take you to pay your debts off. And this is going to be the total interest to pay those debts off. Now, option 2, a lot of people have heard of snowball, avalanche, cash flow index. These are all different sequencing methods to pay the debt off, meaning when debt number 1's paid off, we take that payment, we stack it on to debt 2, and we just keep doing that over and over and over until those debts are gone. So you can clearly see there's an advantage from option 1 to option 2 where we pay a lot less in interest and we do it faster. But what this requires is the discipline of when card number 1 is paid off, you take that payment amount and you stack it on to card number 2 and you just stay disciplined in doing it that way. Option 3 is where we say, what if we run some of your savings, your discretionary income through a policy first, take a policy loan and throw it at that debt. So now what we're doing is we're capturing funds inside of the policy to compound and grow the rest of your life. Now, there's 2 things that's going to happen. By doing it that way, we're going to use extra money for the system. So we're going to pay your debts off faster while we're capturing that compounding. So in this particular case, instead of 56 months to pay off all the debts, all the third-party debts would be gone in 40 months. And this is just one example. Yours would be different. But let's say it takes 40 months to get rid of the Amex card, the Chase card, the medical bills, the car loans, all of the stuff that was on the debt list. Now, for the next 13 months, we're going to be an honest banker. And if you were paying $2,000 in debt payments, that's going to be run right back into your infinite banking system. You're going to be an honest banker and pay that same amount of money back to your own banking system. Net, you're still done in 53 months. And because we had money compounding in the system and we recaptured, you have not only paid less in interest to do it this way. Instead of paying $20,000 in interest, you paid $11,516 in interest, and you now have $33,538 of cash value along with the payment that you used to make. So now you've got, say, $2,000 of debt payments that are cash flow, and we have $33,539 in our policy. What do we do now, Stephen? What's our next step?
Tell me.
We build wealth, right? We get involved in private money club. We look for ways to grow that in multiple places, so we can have our policy growing, and then we take 30,000, put it into a private money club deal at 12%. I mean, that's what we do as step 2, but we've got to get those debts out of your life first. So that's one use case.
Yeah, and people use this strategy for all kinds of things. We just worked with a guy recently, Craig, that I was talking with at an event, and he currently is taking all his money, taking money each month and putting it into a savings account at the bank because he pays his taxes once a year with that money from the savings account. So he's like, well, what if I, instead of saving it at the bank, saved it in this policy and then I pulled it out to pay the taxes each year? Would that be smarter? And yeah, absolutely, because now all that money you're putting in for your taxes each year is in a vehicle that's compounding, uninterrupted, tax-free, guaranteed for the rest of your life. You're still going to be able to use it to pay those taxes each year, but now you have all that wealth growth over here paying your taxes. So now you're actually growing wealth and creating a legacy, doing the exact same thing you were doing anyways, paying taxes. I mean, how many of you would love to grow wealth and create a legacy while paying your taxes? It's little things like that. And so, buying cars, obviously Chris is a big car guy, has all the Porsches and the G-Wagons and everything else. He loves that stuff. And guess what he does? He uses his policies. Why? Because he has a system he created where he can use his policy to buy those vehicles, pay himself back, and actually get back all the money for those vehicles that he buys, drives, and owns. And again, we use that example case study all the time as well on what that looks like. But since we're getting a little short on time here, I just want to share
Good.
one example of using this on a private money loan. And then Craig, if you wanted to share anything else real fast as
Yeah, I
well.
think from there we could there's some questions that are queued up that I want to answer live. So maybe we just go into that mode after share this next example you have.
Yeah, absolutely. And this is just a quick one, just a very simple example of using a policy for growing wealth. And I do like this one because it's a real case study. This was a real estate investor. She lives out west on the west coast of the country. And her goal was to continue doing active real estate. She flipped houses and things of that nature in real estate, and she wanted to continue doing that for the next several years. But just like most real estate investors, they eventually want to slow down on the active side and get more to the passive side of real estate investing, which in our world is known as private money lending. And as Craig mentioned, we can teach you all of this stuff through one of our companies called Private Money Club or on another one of our webinars throughout the week. But for this example right here, this was a policy that I designed for her that she put in force a couple years ago. So this is a couple years old now, but she was 41 years old when this thing started. So the first year of the policy, she put 150. I'll do some drawing on here so you guys can follow along. So that she put $150,000 into this policy. So you're going to see what's called the contract premium. This is how much goes into the policy on an annual basis. Now, a couple notes on this contract premium. First off, if we're a bank, we're using this policy as a banking system. Would you consider this a premium or would you consider this something else? Because the way I look at it, and Craig, I don't know if you do this too as well, but I look at my premium on my whole life policies as a deposit. And the reason I do that is because I know as soon as I deposit money into one of my policies, that cash value is going to immediately grow and I'm going to be able to immediately use that money again, just like I would at any other bank if I was to deposit my money in my checking account at a traditional bank. Not only that, but again, it's back to that whole mindset. We tend to look at premiums as a negative. Like you get a bill in the mail, you look at it, you're like, oh man, I owe another couple $1,000s on my car insurance premium or my insurance premium or whatever the case is. Well, in this case, when you get this in the bill, letting you know what your annual premium is for the policy, I'm excited to get that because I get to put more money into my banking system. So it's just kind of a mindset thing as well. So think of it that way. Also, you can put in whatever amount really you want into these policies. That's up to you. So we'll talk to you on the strategy call about what the maximum amount is you can put into the policy, depending on your financial situation. Again, you do have to financially qualify for this. So you're going to qualify for different amounts, but we'll talk to you about what the maximum amount is. We'll talk to you about what the minimum amount is just to get one started. And we'll talk about where maybe the sweet spot is for your financial situation. And then on top of that, whatever amount we decide on, there's a lot of flexibility on that. So this policy over the next 10 years, she can put as little as $17,500 into this thing. So she does not have to put $50,000 a year into it. She can and has the ability to put up to $50,000 a year into this policy. Now, why $50,000 a year? Because that's what she decided she wanted to do. You can decide whatever amount you decide you want to do. Additionally, the flexibility on this, you don't have to put it in once a year. You can pay into this thing monthly, quarterly, biannually or annually. That choice is completely up to you, and that can change at any time as well. So maybe I start today making annual deposits. Next year, I get to my annual deposit and I'm like, I want to switch over to monthly deposits this year. I start putting that money in monthly. That's completely up to you. You can do all of that. Okay. So just a couple notes on that contract premium or deposit. Now, the other important part of this is over here, the death benefit. Again, that's that little cherry on top. And what is the death benefit? Well, that's the amount if I was to unfortunately pass away, that's the amount of money that will go to my loved ones, my beneficiaries, they're called, completely tax-free. Okay. So that's what money's paid out, and that's what this policy is built on. And then the other important column is right here, the net cash value. So the cash value is the amount that you're able to borrow back out of the policy. Okay. So this first year of this policy, she puts $150,000 in. Well, within 30 days, she can pull back out about $130,000 from this policy. Now, like Craig said before, there's a little tailwind there, a little headwind, I should say. So again, 130,000 is not 150,000. So it's not the full amount, but look what happens over time. Remember, that's the first year within 30 days. So let's just play this out and see what this will look like over time, okay? So let's say she continues to put the money in this policy, borrow it out, do active real estate deals. And again, Craig can illustrate all this using his BYOB tools, but let me just show you what this looks like in the 8th year, okay? So let's say in the 8th year, she decides that she no longer wants to do active real estate, but she wants to use this policy to do private money lending. Well, what happens? Well, in that 8th year, her policy grows by $66,000. Now, to get that $66,000 in cash value growth, she had to deposit $48,593 into annual premium deposit. All right, so if we do the math there, the policy grew by $18,000. So if I look at that as a percentage, that is a 37% cash on cash return. So if you do that math, $18,000 growth of $48,000 initial injection, that's a 37% cash on cash return on our money. So that's excellent. Again, that's a tax-free growth within that policy that year just for depositing the money. I didn't have to do anything. I didn't have to go out there and work any harder. I didn't have to work any longer. I didn't have to take on any more risk. I just changed one thing 8 years prior, and that's where my money went first, into my own banking system, this whole life policy, as opposed to somebody else's savings account. That's all I did was change that one thing. And then what happens with this money? Well, as we've been talking about, not only is the money in there compounding and growing tax-free, but we can simultaneously borrow the money out of there. So when I borrow the money out of a policy, I do pay the insurance company interest to borrow that money out. So that's about a 5% simple interest I'm going to pay annually, depending on the company. But for this example, let's say it's 5%. And let's say that I decide to use that money on a private money loan. Now, pretty common private money loan right now is 12 to 15% in a first lien position loan. So I'll just use 12% for this example. So I put the money in the policy, I immediately borrow the money out and give it to somebody for a private money loan, secured by a first position mortgage, everything we teach in Private Money Club. And I earn 12% that year on my money on that private money loan. So let's do the math on all of that. I made 12% on my private money loan from borrowing the money from the policy. My bank grew that year 37% just by having it. I paid out a negative 5% to the interest company to be able to use that money. So at the end of the year, at the end of the day, I just earned 44% return on my money. So let me ask you this. If I was to borrow that money from a Wells Fargo account and go do a private money loan at 12%, what happens? Well, again, I earned 12% of the private money loan, but I withdrew my money from Wells Fargo to do that private money loan, so I earned nothing extra. In this case, we changed one thing 8 years prior, where our money started going first. And by doing so, we were able to earn 44% as opposed to just 12%. So what would you rather make? We didn't work any harder, we didn't work any longer, and we didn't take on any more risk. What do you think, Craig?
I like that example because it shows the power of what's going on in the policy while we're taking that money and leveraging it again. So yeah, I mean, if there's any questions on that, let us know. I'm just feverishly trying to get through the chat. And
yeah, this is what Chris, Craig, and myself, our entire team, this is, our clients, this is what all of us do, on a daily basis, whether it's making major purchases, whether it's Craig buying a new downhill mountain biking bike. I knew you're all into the physical fitness stuff, or a new guitar even, whether it's myself buying a new boat down here in Florida, or some of the trips we go on and things like that, we try and run as much of this money through we can in these policies. And then, of course, all of the various real estate deals, investments, opportunities, everything that we learn through Private Money Club, through money tank events, through our community, through our campfire. This is all the stuff that we do on a
And
daily basis.
Frank Whipple mentioned in some of the comments about how this just turns into a big rolling snowball over time. And that's a great way to look at it because that compounding machine just keeps getting bigger and bigger. And as we're building that over time and you're doing what Steven just showed, where you're putting that money to work, that interest that's coming back to you from that investment can go buy the things you want. It can buy your cars. I mean, I've done through some of my private lending, some of the proceeds of that have done home improvements. So I'd never paid out of my own capital for that stuff. It's just been the investment proceeds that's paying for that. But yeah, it's a great strategy. And there's a number of things in the chat or in the Q&A that I think we could just answer directly.
Yeah, absolutely. So Nida said, hello, how can we offset the mortgage interest on a home? I heard to be paying bi-weekly helps. Is it true? If not, what can someone do?
Yeah, so I was in the middle of typing that one. It's just kind of my approach would be is I'm not a fan of prepaying mortgages. Now, I know people do that because they want to get their mortgage paid off, but the problem I have with it is every prepayment we make to that mortgage, it kind of locks it up. It's not as if we have access to pull it back out. So think about you're
Yeah,
putting,
correct. Just to clarify that real fast, in case somebody's kind of newer to this. So let's say you're paying $1,000 a month on a mortgage, that's $12,000 a year to go pay
yep,
that mortgage off. Let's say you double that because you're looking to pay off your mortgage early. Okay, so instead of $12,000 that year, you just paid off your mortgage by $24,000. Sounds great, right? Your balance is less. You're going to be able to pay that mortgage off earlier. But what really happens there with that $12,000 extra you paid into that mortgage? It went into the rafters. It went into the walls of your home. You're
yep.
paying off the mortgage, which is increasing the equity you have in that property. But then what? You can't do anything with it. Instead, what if you were to take that $12,000, put it into I don't know, some kind of investment that's paying you an extra couple $100 a month coming in. You take that couple $100 a month, maybe we apply that to the more, we take that and we start building, so there's different ways to look at it. So like Craig said, I just kind of give an example there. Keep going.
Yeah, and so my approach has always been if you can, I look at doing what's called an all-in-one mortgage or a first lien HELOC because at that point you're dealing with simple interest and any money that you prepay into your mortgage is accessible to pull back out the next day if you needed it. So I'm always looking at how do I have control of the money that's in my personal economy. So in a mortgage, I don't like mortgages because it's the devil's arithmetic. You're paying huge amounts of interest per payment. So I want to get out of that world and go into a simple interest world with an all-in-one mortgage or a first lien HELOC. And then at that point, I don't mind sending more money in. Matter of fact, that's what I put everything into. So that's how I would approach it. But I know people have different circumstances, but that's ultimately what I'm after.
Ari said, what's the average IRR on a correctly structured whole life policy? And Ari, it's more about the net internal rate of return, and we can look at that. I mean, you can study that, you can read your contract, you can look at historical data, but it's more the system itself of being able to put your money in there and take advantage of that compounding, uninterrupted returns within that policy over your lifetime, while simultaneously still being able to use that money. And when you look at the whole concept together, sure, the internal rate of return is not going to be the strongest if you're looking at a year-to-year basis, but when you look at over time and that thing, how it starts to compound after 7, 8, 9, 10 plus years, and then from there, it's just a silliness. But when you look at that compounding returns, it kind of, so you really got to do what we talked at the beginning, where you're changing your mindset and the perspective a little bit. Where the IRR, sure, you want to look at it, it's interesting, but at the end of the day, in the financial strategy, it really means nothing. And I don't want to say it that way because I don't want to discount it, but it really doesn't. But the annual dividends these policies pay, just to kind of clarify, is typically around 5 to 6.5% right now annually.
Yeah, and the thing that jumps out to me about IRR is you're going into it with an investment mindset, which the policy, and it's really important to understand this, the whole life policy is not an investment. And by definition, when we talk about investments, investments carry risk. They carry the opportunity to lose money. When you're funding the policy, there are guarantees inside of the policy, right? You have guaranteed growth, guaranteed death benefit, and then we want to leverage those non-guaranteed dividends. So like Steven said, if you want to look at the IRR, you can do the math, you can do the calculations. Matter of fact, some of the illustrations will actually show that. But what we're doing is we're building that compounding machine and then doing something else with it. We're not just building it and letting it sit there. So the IRR becomes more complex because you not only have what the growth of the policy is, plus what you're doing with it. If you're putting it into a deal, 12%, 15%, you're making money there twice. Okay, so Sam says, "Hey Craig, I'm driving right now. Hopefully you're driving safe and not texting here, but cannot read, but can you please ask Steven to talk about how to integrate a self-directed IRA into the system?"
Yeah, I mean, so a self-directed IRA is just an IRA. So everybody knows what, an individual or retirement account or individual retirement arrangement is. There's traditional IRAs, there's Roth IRAs, there's self-health savings accounts, there's all these different types of retirement accounts out there. And at the end of the day, they're all just different tax, the traditional IRA is going to be deferred tax. Roth IRA is going to be tax-free growth, but you pay the taxes up front. So there's different tax advantages to each one of them, but they all have their own set of rules. If you pull the money out early, you can be penalized for doing so. Now, the ultimate, if you are going to have IRAs, would be self-directed because it allows you to invest in things outside of the stock market. So you don't have to be stuck with individual stocks or ETFs or mutual funds and different types of things like that within the stock market. Self-directing allows you to buy precious metals, allows you to buy real estate, investment properties, flip houses, wholesale, private money lending, get into all different types of real estate deals. You can buy businesses, you can buy IP with self-directed IRAs. I mean, one of the most famous self-directed stories was Peter Thiel, one of the founders of PayPal. He had something like a couple 100,000 or a million in an old 401k. He transferred it over to a self-directed IRA. He used some of that money at the beginning days of PayPal to put it into stocks. When PayPal sold, he ended up having like $1 billion of growth within his Roth IRA. So he basically made $1 billion or whatever the amount was. You can Google this story and look for the exact numbers, but something like $1 billion he made tax-free by using the Roth IRA that way. So it's a huge advantage to doing so. Using it, but one of the best ways for me for self-directed is if you have an old 401k, you already have some money sitting there. It doesn't make sense to get penalized to withdraw it. Just move it to a self-directed IRA, start doing private money lending or something with it. I mean, that's my favorite strategy, but at the end of the day, you can't really use it with whole life insurance or with the infinite banking concept. Those really need to stay separate. So you want to look at using it with it. You want to use it as a complementary strategy for what you're doing with your infinite banking system. So I hope that makes sense, Sam.
Yep. The next two are both related to policy loans, and so I'm going to try to combine the response to this. So Margaret says, "Is it best to pay off a policy loan sooner than later or make monthly payments?" And then Warren's wanting to know, when you pay back policy loan with interest, does that help you pay the loan back faster, or do you end up paying more back in your policy than you really originally took out? So here's kind of the way policy loans work at a high level. Let's say that you take a $10,000 policy loan and the loan interest is 5%. If you don't pay anything back towards that loan, whether principal or interest, throughout the year, you will have a $500 interest charge at the end of the year. And that, well, I should say end of the year, that's your policy anniversary. It's the end of your policy anniversary. There would be a $500 interest charge. Now, you as the banker can say, you know what, I don't want to pay it. And what the insurance company will do is they'll put that onto your principal. So in year two, your balance is now $10,500. That's what happens with interest. If you don't pay it, it gets tacked onto the principal going into year two. Now let's think about what's happening throughout the year. Any loan repayments that you make to your policy loan, 100% of that's going to the principal. It's a simple interest loan, 100% is going to principal, and then they calculate interest off of that. So let's just say that you had a $10,000 loan at 5%, you paid $500 a month back to that loan. Well, every $500 increases your available cash value. It reduces your principal, which reduces your interest charge. Your actual interest rate is going to be somewhere around 3.3%, not 5%, because you paid principal down throughout the year. Isn't that cool? And we can show you the math. We did this on an Ask Me Anything a couple weeks ago, where can you take a 5% policy loan, pay it back at a 2.5% rate over 5 years and still make money? You can. We have calculators to show you that. People are like, no way, you can't do that. But you can. And you're actually, if you paid back a 5% policy loan at 2.5%, you'd make about $15 over 5 years. Whoopee. But it's still pretty cool just to see how that math works out. So that would be the first part of the loan picture. Now, we talk about being an honest banker. If you're going to get a car loan from a dealership and they say, structured at 8% or 9%, you're going to pay your policy loan back faster because it's a 5% simple interest. So to Warren's question, what do you do with that extra? What do you do with that amount of money that can't go back into the loan repayment because it's paid off? That's where we try to put it into the premium side of the policy in what's called paid up additions, which helps your compounding and growth. So there may be room there may not be, but that's what we have to decide is there any additional capacity where we can put that into your premium side? Hopefully that helped. I know it's a lot of math, but we can show you that in your specific situation because we've got the calculators to do so. Let us know if there's any follow-ups to those questions.
Yeah. Nicely handled, Craig. All right, cool, guys. I know we're about 15 minutes over already, so we're going to go ahead and wrap this thing up. Appreciate everybody being here today. If you do think of any other questions, just make sure you schedule a call with our team, mentors.beyourownbanker.com/www. They can answer those questions. We'll also be right back on a live stream at 4:30 Eastern today. So in about a little under 2 hours, we will be live on the YouTube channel as well as on Facebook. So hop on live at 4:30 p.m. Eastern, youtube.com/@the-Chris-Naugle, or you can follow Chris or myself on Facebook. It always streams on those each week as well. And we'll be answering all of your questions for 1 hour at the Ask Me Anything happy hour, 4:30 Eastern. But we appreciate everybody being here today. Hopefully you guys got something out of this. Craig, thank you very much for your time and expertise. And we'll see you guys same time, same place next Wednesday. Thanks.
All right. Thank you all.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.